powerful, secretive, and unaccountable institutions in U.S. history. Its insulation from oversight, combined with massive coffers and strong statutory authorities, makes it a uniquely troubling institution. To give you an idea of just how powerful the Fed is, in 2018, Forbes ranked Jerome Powell, the chairman of the Federal Reserve Board, as the 11th most powerful person in the world, ahead of the prime ministers of France and the United Kingdom. Sorry, England and France, but earnest oversight, though, I think is long overdue. Current law prohibits the Government Accountability Office from auditing the Fed's vast monetary policy functions, and the Fed's Inspector General serves at the pleasure of the Fed Board of Governors, the very institution it's supposed to hold accountable. This summer, I began investigating the Fed, and after months of stonewalling, the Fed finally produced information on one of the most significant tools of monetary policy, interest on reserve balances, or IORB. The interest on the reserve balances system began after the 2008 financial crisis, when the Fed aggressively purchased assets to flood the market with liquidity. This marked the beginning of a transition from the scarce resource reserves regime to an abundant reserves regime. The Fed vastly underestimated how the transition would play out. Initial estimates put the cost of the transition at about $35 billion. As of May 2022, these estimates increased to $2.3 trillion. Under this new regime of abundant reserves, banks would receive interest payments, known as interest on reserve balances on deposits held at the accounts in the Fed. When interest rates are low and the Fed's balance sheet is small, this is a manageable regime. Unfortunately, since 2008, both the size of the balance sheet and interest rates have increased the cost of this regime to unsustainable levels. Take the size of the Fed's balance sheet. Before 2008, it was approximately 5% of GDP. After the great financial crisis, it rose steadily, reaching approximately 18% of GDP. During the COVID pandemic, it soared to a record 35% of GDP in 2022. It's since fallen to approximately 21% today, but remains well above historic levels. When interest rates were near zero from 2010 to 2016, the Fed had to pay little in the form of interest on reserve balances. But when inflation concerns required the Fed to raise interest rates from 2016 to 2019, and again from 2022 to 2023, the interest on the reserve balance rate was a primary tool to do so, requiring the Fed to increase the amounts it was paying to banks to get them to hold money at the Fed. This led to distortions in the federal funds markets, including periods where short-term Treasury yields were actually below the interest on reserve balance rates. When this happens, the Fed loses money and taxpayers underwrite the losses. It's somewhat of a crazy notion to even imagine an organization that actually has the ability to print and create currency losing money, but the Fed has been losing money for the last couple of years. The Fed is supposed to send its profits to the Treasury. The interest on reserve balance system, though, however, has led to 2 years of operating losses where instead of the money going back to the Treasury, the money's going to large banks in New York and large banks overseas. The Fed is taking the federal funds rate, and most of this ends up in the largest banks in the world, both foreign and domestic. It's a double whammy for the taxpayers. Banks use your money that's sitting in a checking account to earn up to 5.4% interest from the Fed, the payment of which is underwritten by your tax dollars. Then you pay on average of 0.0% interest on your checking accounts, and they pocket the difference. It's great for banks. Interest on reserve balance enables the Fed, without any form of oversight or elections, to unilaterally transfer wealth from the American taxpayer to the biggest banks on Wall Street. Interest on reserve balances have totaled hundreds of billions of dollars. Most people even don't know they exist. Since 2013, the Fed has paid $607 billion to both foreign and domestic banking institutions. In 2024 alone, the payments amounted to $186 billion. This is essentially 10% of our deficit. So our deficit could have been reduced by 10% if that money were going back to the Treasury instead of going to private banks. The secrecy surrounding the amounts of these payments have allowed unelected officials at the Fed to influence the American economy in ways that rival the power of elected members of Congress. For the first time ever, the report I released this week revealed the true nature of these payments. The data I obtained from the Fed shows that the largest banks in the country made a windfall. Big names like JP Morgan Chase, Bank of America, Citi, Wells Fargo, and U.S. Bank raked in tens of billions of dollars from holding their money at the Fed and essentially not loaning it to the public. From 2013 to 2024, interest on reserve balance payments to the top 5 banks amounted to $136 billion, which equals 12% of their profits. So over 10% of the profit of the banks is basically being paid at no risk to these banks. They're not going out and loaning money. They're not, having to judge risks of loaning it. They just park it at the Fed and are able to gather 10% of profit with no risk. Money wasn't just flowing to Wall Street, though. Foreign banks also cashed in. 11 of the top 20 recipients of interest on reserve balances from 2013 to the present were foreign banks. It's kind of hard to fathom that we're using this, quasi-governmental bank, the Federal Reserve, to facilitate payments to foreign banks. These funds aren't exclusive to allied nations. Chinese banks alone received about $10 billion in interest on reserve balance payments. Oversight of the Fed's interest on reserve balance payments is the first step in finally auditing the Fed, but there's still much more work to be done. My bill, End the Fed's Big Bank Bailout, would end the forcible transfer of wealth from average Americans to Wall Street institutions under the guise of interest on reserve balance payments. While my Federal Reserve Transparency Act, Audit the Fed, would also allow meaningful oversight of all functions of the Fed, which is long overdue. If the Fed handed over the data, if the Fed handed over this data, what is it hiding? What is the information they're still refusing to release? It was like pulling teeth to get the information we finally got from them. But I think it's high time that we do audit the Fed. Senator Peters.
Well, thank you, Chairman Paul, and thank you for each of our witnesses for being here before the committee today. The Federal Reserve plays a critical role in implementing sound monetary policy to strengthen markets as well as the overall economy. The focus of today's hearing is on the Fed's authority to pay interest on reserve balances, which Congress created under the Financial Services Regulatory Relief Act of 2006 and directed the Fed to implement in response to the 2008 financial crisis. Commercial banks hold cash balances at the Fed, known as reserves, that play an important role in keeping financial markets functioning. The Fed pays interest on those reserves, allowing the Fed to set target interest rates that affect rates on everything from mortgages to car loans. The Fed also receives interest payments from banks on the securities backing those reserves, which the Fed then sends to the Treasury in the form of remittances. According to publicly available data, in the past 16 years that the Fed has held this authority, it has actually remitted over $900 billion to the United States Treasury, even after making interest payments. Over the last 2 years, although the last 2 years saw negative remittances primarily due to the necessary responses in support of the economy during the COVID-19 pandemic, the Fed has recently stated that it expects its negative remittances to turn positive again very soon. Repealing this authority would not save any money for the taxpayers. And without this authority, the Fed would lose control of its ability to set a floor interest rate for lending. Economists predict this would result in collapsing interest rates and much higher inflation, something we have quite enough of already. To restore rates, the Fed would need to shrink the level of reserves at an unprecedented speed and volume, introducing volatility, comprising market resilience, and leaving banks prone to shocks. Stability is absolutely critical. American financial markets remain the envy of the world, in no small part due to the stability, the efficiency, and liquidity provided by the Fed. If banks did not receive these payments on their reserves, they would simply buy other government securities that the government pays interest on, like Treasury securities, and as a result, be more prone to economic volatility. Ultimately, this all comes back to affordability and making our economy work for small businesses and families. Economists argue that repealing this authority would disproportionately harm small and community banks and make borrowing harder for both businesses as well as consumers. Unfortunately, like so many things under President Trump, the Fed has been needlessly politicized. We are currently facing a dangerous, ongoing threat to the Fed's independence. After repeatedly pressuring the Fed to lower interest rates, President Trump has tried to fire Governor Lisa Cook and has called Chair Jerome Powell to be replaced. These actions are politically motivated, and Congress should stand up for the Fed's independence and ensure that monetary policy remains insulated from political pressure. And finally, Mr. Chairman, while the oversight of the Federal Reserve is certainly important, this committee, I think, has not held oversight hearings on numerous topics that are actually in our jurisdiction, including FEMA's failure to responding to disastrous floods in Texas this spring, persistent cyber attacks by our adversaries against federal IT and critical infrastructure networks, or the administration's efforts on border security and drug trafficking. In fact, our colleagues in the House, the Homeland Security Committee in the House, today are actually sitting down right now as we speak with Secretary Noem across the Capitol to talk about threats posed to the homeland, a serious topic that certainly demands the attention of this committee, not just the House committee. Mr. Chairman, so I hope we will also prioritize hearings with administrative officials in the near future so we can fulfill that responsibility. And again, to our witnesses, thank you for being here.
It is the practice of this committee to swear in witnesses. Will each of you please stand and raise your right hand? Do you swear that the testimony you will give before this committee will be the truth, the whole truth, and nothing but the truth, so help you God? Thank you. You may be seated. Our first witness will be Norbert J. Michel, Vice President and Director of Cato Institute's Center for Monetary and Financial Alternatives. Dr. Michel leads a team of nearly 12 scholars that develop original policy solutions to expand freedom through improving financial markets and monetary policy. In addition to producing policy publication, his team regularly engages with policymakers on Capitol Hill. Dr. Michel, you are recognized.
Good morning, Chairman Paul, Ranking Member Peters, members of the committee. Thank you for the opportunity to testify today. I am Norbert Michel, Vice President, Director with the Center for Monetary and Financial Alternatives at the Cato Institute, but the views that I express in this testimony are my own and should not be construed as representing any official position of the Cato Institute. In my testimony today, I argue that it is time to wind down the Federal Reserve's balance sheet, and once that wind down is complete, end the Fed's ability to pay interest on reserves. Importantly, these policy goals can be accomplished without harming the American economy. As part of its response to the 2008 financial crisis, the Federal Reserve purchased large quantities of long-term treasuries and mortgage-backed securities. The Fed's securities holdings ballooned from less than $1 trillion to $4.5 trillion, and on the eve of the COVID-19 pandemic remained elevated at approximately $4 trillion. Then a new round of purchases pushed this figure up to almost $9 trillion. As the first round of these purchases occurred, the public generally feared the Fed was stoking a massive inflation problem, and they were correct to be concerned. Under a traditional monetary policy framework, Fed purchases are equivalent to expansionary monetary policy. However, during this period, the Fed also changed its operating framework to one that could no longer be considered traditional. The main feature was that the Fed started paying interest on banks' reserves. This new feature received much less attention than the Fed's asset purchases themselves, partly because interest rates were historically low at that time. As many people recognize, though, if and when rates eventually rose, the Fed would have to start paying large amounts of money on reserves, a move that would imperil its profitability and, therefore, its remittance to Treasury. It would also put it in a politically difficult position. After the post-COVID-19 rise in inflation, that time finally came. The Fed's interest payments increased dramatically, and the rate of increase in interest expenses closely mirrored the rate of increase in the IOR rate, the rate that the Fed pays out on reserves. This latter fact was not true in the late 2010s when the Fed raised the IOR but kept interest payments in check because it only paid interest on excess reserves as opposed to all reserves, a policy it changed during the pandemic. These large interest expenses resulted in the Fed's only recorded losses since 2008 and the only losses on record since the data has been available. Between 2023 and 24, the Fed has lost nearly $200 billion, and it will likely take years of future profits to offset those losses from these past 2 years alone, profits that would usually go to Treasury. One obvious problem with this trend is that interest rates may not come down to their pre-pandemic levels, thereby failing to reduce the Fed's interest burden and allowing its financials to turn back to profit. However, regardless of the future path of interest rates, there are several other problems with the IOR framework that dictate it should be ended. For instance, this IOR framework provides government dollars to large financial institutions at risk-free interest rates, essentially giving banks a massive government handout. The average American has no access to this risk-free investment. Next, the IOR framework leaves banks with less of an incentive to borrow from each other or lend funds to the public, resulting in lowered activity in private markets. Then, potentially, large financial losses will also undermine the Fed's ability to support the banking sector and the U.S. government's ability to issue new debt. The losses create a potential complication for monetary policy because the Fed must increase the IOR in order to combat inflation, even though every increase in the IOR increases the Fed's potential losses. And then last, and perhaps the most dangerous issue, is that the IOR framework effectively divorces the Fed's monetary policy stance from the size of its balance sheet. In other words, the Fed's asset purchases, which increase bank reserves, are no longer automatically associated with expansionary monetary policy and inflation. This feature increases the likelihood that the Fed will be used as a pawn of the Treasury, enabling the government to run even larger deficits and open new opportunities for political groups to pressure the Fed for direct funding, something that we've already seen start to happen. Congress should require the Fed to shrink its balance sheet in no more than 15 years, which is approximately the same amount of time it took to enlarge the balance sheet from 2008. Faster would certainly be better. The goal should be to reduce the Fed's holdings to no more than the pre-2008 share of the commercial banking sector, which was approximately 10%. At that time, the Fed's authority to pay interest on reserves should be repealed. Thank you for your consideration. I'm happy to answer any questions you may have.
Our next witness is Ryan Young. Ryan is a senior economist at the Competitive Enterprise Institute. He specializes in trade, regulatory reform, antitrust policy, monetary policy, and other issues. He edited the essay collection Adam Smith's Guide to Life, Loveliness, and the Modern Economy, and his writing has appeared in USA Today, The Wall Street Journal, Politico, and dozens of other publications. Mr. Young.
Chairman Paul, Ranking Member Peters, distinguished members of the committee, thank you for holding this hearing and inviting me to testify today. My name is Ryan Young. My work focuses on monetary policy, trade policy, and regulatory policy at the Competitive Enterprise Institute, a nonpartisan public policy organization that concentrates on regulatory issues from a free market perspective. I am pleased to speak to you today about a bipartisan goal, ending interest on reserve bank deposits, or IORB. This is the practice of the Federal Reserve paying interest on account balances that other banks hold at the Fed. IORB was enacted in 2008 in response to the financial crisis. It has since proven to have few benefits and many drawbacks, and it's time to end it. The two IORB problems I wish to highlight today are cronyism and inflation. First, cronyism. The committee's report points out that in 2024, the Fed paid about $180 billion in IORB to banks. While this number is likely to drop in 2025 and 2026 due to lower interest rates, it is still a bad look for the Fed. IORB is free money for banks that don't need the help. Similar to Wall Street bailouts from past years, free IORB money encourages banks to take on risks they would otherwise avoid and at taxpayer expense if they go bad. As we have found out the hard way several times over the years, extended excessive risk-taking rarely ends well. If a recession or a financial crisis hits, IORB could be both a contributor to the problem and a prelude to more taxpayer bailouts. The money spent on IORB payments has other potential uses. It could have gone to the Treasury instead. $180 billion is equivalent to about 1/10 of last year's budget deficit. Savings from ending IORB could also have more than covered the Fed's 2024 operating losses of $114 billion. The second IORB problem I wish to discuss is inflation. IORB raises inflation risk in two ways. First, by potentially influencing the Fed's federal fund rate decisions, and second, by influencing its open market operations policies. A high federal funds rate already has unintended consequences, such as higher interest rates on government bonds. This makes government debt more expensive to repay and is one reason why the political branches often pressure the Fed to lower rates. IORB creates an additional unintended consequence. The higher the federal funds rate, the higher the Fed's Board of Governors has to set the IORB rate. Otherwise, banks will take their money out of the Fed and try to earn a better return elsewhere. But the higher the IORB rate, the more likely is the Fed to incur an operating loss. In fact, IORB payments alone exceeded the Fed's 2023 and 2024 operating losses. The Federal Open Market Committee, or FOMC, has a tough job as it is. IORB makes its job even more difficult. IORB, especially at the large scale it has reached in recent years, can potentially influence the FOMC to set interest rates lower than it would otherwise prefer in order to save money on IORB payments. IORB can also tempt the Fed to grow the money supply through open market operations, which can also cause higher inflation. If you or I were to buy government bonds, we would have to use our own money and take that money away from other potential uses. Unlike us, the Fed doesn't have to navigate that trade-off. If it wants, it can buy government bonds with dollars it newly creates out of thin air. This is how the Fed can directly grow the money supply. This was also the main driver of COVID-era inflation. From 2020 to 2022, the Fed added nearly $5 trillion to its balance sheet. This roughly quadrupled its usual rate of money supply growth, and the inflation rate roughly quadrupled to match. The Fed could do something similar to fund IORB payments. This would help it duck criticism for using IORB money to subsidize foreign and domestic banks. Rather than address its problems, the Fed could simply create more dollars in an attempt to have its cake and eat it too. This money supply growth has a trade-off, and that trade-off is higher inflation. Fortunately, $180 billion will do far less damage than $5 trillion did, but there is no need to make the FOMC's job even harder than it already is. Trial and error are essential to the public policy process. After a 17-year trial, we now know that IORB was an error. You now have the opportunity to fix it. Thank you for this opportunity. I look forward to your questions.
Thank you. Our next witness is Brian Westbury. He's the chief economist at First Trust Advisors. LP Brian has been a member of the Academic Advisory Council of the Federal Reserve Bank of Chicago, as well as a fellow of the George W. Bush Presidential Center in Dallas. Previously, Brian served as chief economist of the Joint Economic Committee and has been ranked by the Wall Street Journal as the nation's #1 economic forecaster. Mr. Westbury.
Thank you, Chairman Paul and Ranking Member Peters. Thank you for inviting me, members of the committee. I would like to submit my testimony into the record. I'm going to summarize it as I kind of go through this just in my mind, because listening to all of this, your committee and your staff has done fantastic work. And I know pulling information out of the Fed is very difficult. And so I really appreciate what you have done here. And you've highlighted this interest on excess reserves. And I would like to say that this is pulling on this thread is like unwinding the whole sweater, the fabric of this new monetary policy. It was started in 2008 during the great financial crisis, and I believe it's supported by a myth. People believe that quantitative easing saved us during the great financial crisis, and I do not believe that. I think it was changing mark-to-market accounting rules that did. Nonetheless, it's lasted. And so I want to think about what it really is. The Federal Reserve, at the same time governments during COVID and during 2008 boosted their purchases of government bonds. So the government is issuing a lot of debt. The Federal Reserve is buying it. If banks were forced to buy it, they would have a different risk profile, as Ryan just highlighted, than the Fed. The Fed doesn't care about losses. And as a result, the government can issue more debt at a lower rate than it would be able to if it had to sell it into the private marketplace. And what this did, in my opinion, is it allowed the government to grow bigger than it would have been able to if the Fed would not have followed this abundant reserve policy. The second thing is it did not help stabilize the financial system. If you go back to the great financial crisis, the subprime loan losses were somewhere around $400 or $500 billion. The system today, as it stands, has losses of over $1.5 trillion. So in other words, we've tripled the amount of losses in the banking system and at the Fed today versus what existed at the beginning of the great financial crisis. The other thing that's happened is that we have tripled the money supply since 2008. The M2 money supply was $7 trillion in 2008. Today, it's $22 trillion. Let me put that in stark terms. If you have a $100 bill in your wallet, 67 of those dollars were created in just the last 18 years. 33 of those dollars were created in the previous 200 years. That's how much money we printed, and that's why we ended up with the inflation that we have. This is what's created the unaffordability problem, because people with assets, one, if you already own a home, your home rose in value. If you own equities, your equities went up. If you don't own a home or equities, you just face higher inflation. And I believe this policy has created more inequality in America than any government policies we have ever followed in our history. And as a result, I think it's undermined our political dynamic. It has created haves and have-nots. It has created a divide between older generations that have built up assets and younger generations that haven't. And as a result, I believe this policy has been a complete failure in our system. It's created inflation. It's created more risk. It's also created this appearance of paying private banks and foreign banks money. And it's taken the risk away from the government of issuing debt into the private sector. I think it needs to be unwound and unwound completely, and never allowed to come back again. Thank you very much for the time.
Our next witness, Dr. Cohn, formerly served as a member and then vice chair of the Federal Reserve Board of Governors from 2002 to 2010. Previously, he held several staff positions, including Secretary of the Federal Open Market Committee and Director of the Division of Monetary Affairs. Dr. Cohn also advised Federal Reserve Chairman Ben Bernanke throughout the 2008 and 2009 financial crisis, and former Chairman Alan Greenspan. He received a bachelor's degree in economics from the College of Worcester, and more significantly, a PhD in economics from the University of Michigan. So no one would question the academic rigor of your studies at that fine institution. Dr. Cohn, welcome to the committee. Thank you for your expertise. You may proceed with your opening remarks.
Thank you, Senator Peters, and thank you, Chairman Paul, for inviting me. In my view, the payment of interest on reserve balances serves critical public policy purposes and should be retained. IORB is required to enable the Federal Reserve to take actions to meet its legislative monetary policy mandates for maximum employment and stable prices. When the economy and employment are weak, the Federal Reserve normally reduces its target for short-term rates to stimulate spending. Twice in the past 20 years, the Fed has lowered its target to zero, but recovery from recession still has been slow or uncertain. In these circumstances, to reduce longer-term interest rates further, encourage spending and job creation, avoid persistent deflation, the Fed purchases longer-term government securities. Those purchases create a large volume of reserves, And when it comes time to raise interest rates, inflation fighting depends on raising the IORB, which puts a floor under market interest rates. IORB also supports the Federal Reserve's ability to foster financial stability. It enables the Federal Reserve to make purchases to stabilize Treasury agency and MBS markets when they're disrupted, threatening the flow of credit to public and private borrowers. Markets seized up in late 2008 and again in the spring of 2020. Because of IORB, the Federal Reserve was able to step in, make purchases of securities to restore market functioning, assure credit flowing to businesses and households, and they were able to do that without losing control of monetary policy. IORB means the Fed can supply reserves to enhance the resilience of the banking system to unexpected adverse liquidity shocks such as deposit runs. Deposits at the Fed are the safest, most liquid assets banks can hold. IORB means that banks see reserves as a viable source of liquidity to manage risks without harming the bottom line. And with IORB, the Fed can meet their demands for this asset without sacrificing its ability to control short-term rates for monetary policy purposes. Being able to use interest-bearing deposits at the Fed to manage liquidity is especially important for smaller banks. Larger banks have access to a much wider variety of instruments to meet unexpected outflows. IORB does not result in a windfall to banks. Banks have to fund their holdings of reserves with deposits or borrowing, just as they do with other assets they hold. Banks pay interest and face other costs associated with those sources of funding. The rate paid on reserves is very close to the rate on a range of other short-term instruments which banks and others can borrow and invest. Moreover, any individual bank can increase its holdings of reserves by raising its deposit rate to attract new funds and leaving the funds in its reserve account. If the rate paid on reserves offered banks an excessive profit, increased competition in our market system among banks for deposits would push up bank funding costs, offsetting that profit. IORB will not result in a net cost to the Treasury over the long run. While a larger Fed balance sheet means the Fed is supplying more reserves to banks on which it pays interest, it also means that the Fed is holding more government securities purchased with those reserves, and it earns interest on those. Fed interest income and expense can differ significantly in some periods. This is a temporary condition. Over time, the effects of a larger Fed balance sheet on interest payments to banks and interest receipts on securities should be roughly offsetting. IORB and ample reserves do not crowd out consumer or business lending. Deposits are the counterpart of those reserves. When a bank receives a deposit, it compares the risk-adjusted returns on various uses of the deposit. Before IORB, a bank might compare making a loan to lending to another bank in the federal funds market. Today, the bank compares making the loan to holding on to the deposit at the Fed. IORB is almost identical to the funds rate, so it hasn't altered this calculus about making loans. While not allowing the Fed to pay interest on reserve balances would have little effect on Treasury income over time or bank profits, it would handicap the Fed's ability to promote economic and financial stability. It should be left in place. If Congress wishes to raise additional taxes from banks, it should do so directly, not by forcing them to make interest-free loans to the government. Thank you, Mr. Chairman.
Thank you for your testimony. I would like to enter into the record the report produced by the committee majority as part of this investigation. Without objection, these records will be entered into the hearing record. We will now proceed to questions where each member will have 5 minutes. We will start with Senator Johnson.
So have you all read Creature from Jekyll Island? Have you all read it?
Read what?
Creature from
The basic premise of that is the Federal Reserve is a cartel of the big banks, and,
right.
and it shouldn't be there, okay? And to a certain extent, I find this debate very confusing. I think part of it is we should have a Federal Reserve. We should run monetary policy a different way. I'm not sure how you do that. I don't think anybody really understands monetary policy. We try things and they don't work. But hear me out and tell me where I'm wrong. If the Fed runs a $200 billion loss because it's paying interest on these reserves, it's basically hiding a $200 billion loss that otherwise would be shown on our books. You know, instead of a $1.9 trillion deficit, we have $2.1 trillion deficit. Is that basically true? We're just basically, I mean, we're allowing this supposedly independent agency, I don't think it's particularly independent, but it's running a $200 billion deficit while fiscally we're running $1.9 trillion deficit. So it's just like, it's a shell game. It's, you know, where are we doing it? Now, I understand the impact potentially on inflation is it allows us to run higher deficits because we're kind of hiding that interest expense. Personally, I don't think that would restrain Congress. I think we'd just run we will run a $2.1 trillion deficit. So where am I missing this? Because I also hear the arguments from other Fed presidents that, again, if they're not paying interest on the reserves, they'll just buy a Treasury bill anyway. And again, that's where the government is on the hook for another $200 billion. As Mr. Cohen talked about, interest rates are pretty equivalent. So I guess where am I wrong? And briefly, please.
Sure. I wouldn't say that you're wrong. I think you could absolutely look at it, and you could make an argument that you should look at a unified federal budget, and there would be no problem there at all. It is either in one place or the other right now, but it's all in the same place.
Okay. Again, if you could all get your mics a little bit closer because it's kind of hard to hear you.
Yeah.
Mr. Westbury?
Yeah, well, the United Kingdom takes the loss that the Bank of England has the same loss. Because they pay interest, they're paying more in interest to their banks than they are earning from the bonds that the Bank of England owns. And they take that loss and put it into their deficit. In fact, they've had a big political fight about how they are able to increase spending because the central bank's losing money.
This is a problem masking the true deficit.
And what
really $200 billion. Okay, so yeah, I would argue that's a problem. I don't think it's a massive problem. Mr. Westbury, you mentioned that we've increased the money supply. You said 2008, was it?
2008 to today, we've tripled it.
You know, basically a dollar you held then. Here's the fact. I mean, a dollar you held in 1998 is worth 51 cents. Mm-hmm. A dollar you held in 2014 is worth 74 cents. A dollar you held in 2019 is worth 80 cents.
Right.
But the money supply increased a lot more than that.
Right.
So what's the difference? I mean, why isn't it a direct relationship?
Because the Federal Reserve, as they've added money to the banking system through this process of quantitative easing, has instituted heavier capital requirements and liquidity rules on banks. In other words, they have flooded the system with money, but then they have forced the banks to hold on to that money. And as a result, it didn't turn into inflation as much as you might have thought. After the 2008 quantitative easing, everybody thought inflation was going to pick up, and it didn't. However, it did during COVID, and the difference was...
That's just my point.
Yeah.
Everybody thought inflation would explode, and it didn't.
Yeah, it didn't.
Again, that's what's so confusing. I mean, this is why I focus on fiscal policy. I mean, to me, the problem is we're running these enormous deficits. We're going to finance it one way or the other. Either finance it through the Fed or we finance it through the Treasury and selling bonds. We're screwed either way. I mean, we need to get our fiscal house in order. We can argue about this. Again, I don't know that we should pay him or not. I don't think it really makes that much difference. I mean, I understand the arguments. Okay, it hides it that in theory would increase inflation, although we thought it would and it didn't. So again, my point would be, I guess I'm running out of time, is we need to focus on fiscal problems, our massive fiscal deficits, and how we finance it, it's kind of a horse apiece.
Let's hear Dr. Cohn, I think, wanted to respond.
No, I just wanted to point out to the senator that there's never been a really tight relationship between money supply and inflation. there's been a long-term relationship, but it's not that tight. And as you and Brian talked, there was a lot of discussion in the 2010s about how this blow up in the balance sheet and in the money supply was going to cause inflation, and inflation was very low the whole time. People were surprised at how low it was. So you can't.
Which again underscores my point. I really don't think we understand monetary, that nobody does. I mean, it's a guessing game.
I would also say that while there's not an exact mathematical correlation, increasing the money supply is what causes inflation. I don't think that's disputed. Mr. Westbrook?
Yeah, I did not expect inflation after 2008 because the M2 money supply was contained with regulatory rules. All right, I did expect inflation during COVID because we relaxed those regulatory rules and M2 exploded. It was one of the easiest forecasts I've ever made in my career. And Chairman Paul is exactly right. M2, it's money printing that causes inflation. And that's what worries me about quantitative easing is we've flooded the system, and if we let it out, then it becomes inflation. And then the second quick point, it's not about interest rates because Chairman Bernanke held interest rates at 0 for 7 years and we didn't get inflation. Chairman Powell only held them at 0 for 2 years and we had 9% inflation. So it's not about rates, it's about the money supply. And that's why taking away the ability to pay interest on reserves will not cause inflation. That's not what causes inflation. It's the money supply that does.
Senator Peters?
Dr. Cohen, let's try to have a focused answer to try to answer something related to exactly what we're dealing right now. You emphasized in your testimony the importance of interest on reserve balances as a tool in monetary policy. So for the committee, and all of you talked about this, I'm going to try to distill it down for us. Why is this authority necessary to retain in order to maintain a strong economy? And what are the risks if we repeal it? How would you summarize that quickly for us?
So I think there are a couple things there. One, Senator Peters, one is when the economy is very weak and the Fed reduces its interest rates to 0, as Brian was just talking about, then and the economy remains weak, or they're concerned that the economy will remain weak, this is 20-teens, you need to do something else to stimulate spending. You need to lower mortgage rates to get people to buy houses, to get lower interest rates to get people to buy cars, et cetera. And that's what QE does. That's what buying the securities does. Once the Fed has bought so buying those securities helps stabilize the economy and promote employment. Once the Fed does that, it really needs the interest on reserves then to tighten policy to fight inflation, as it did in 2022. It was a bit late to that game, I agree, and I've made that criticism publicly, but it did fight, and it did it with IORB. Without IORB, it wouldn't have been able to stabilize the system when COVID hit, which is a big difference there, a lot of COVID distortions, and it wouldn't have been able to fight inflation, and it's brought it from 6 down to 3 without IORB. So very important for stabilizing the economy and fighting inflation.
So you made the argument why it's important. I'd like to turn to the idea that we've heard that banks are receiving a windfall as a result of this. How would you respond to that, to those who would argue that?
So banks have to get those reserves somehow. The Fed goes out and it buys securities from someone holding Treasury securities. That person then takes the deposit and puts it in the bank. That person isn't going to deposit it at 0.5 interest rate, right? It's going to want a rate that's somewhat comparable to the securities that's sold to the Fed. So, and then the bank then has the deposit at the Federal Reserve. So the bank has attracted a deposit that pays almost what it's being paid at the Federal Reserve. You can't compare the money that the Fed pays to the banks to net interest margin. You have to talk about what the banks have paid to get that money. And my view is they're paying something comparable to IORB in order to get that money. So the net to the banks, the net profit to the banks is is quite small.
In fact, those remittances are back to the Treasury, which I mentioned in my opening comments. I also mentioned that the Fed is asserting that it's going to return to positive remittances back to the Treasury in the near future. Would you agree with that? And explain to us what that means for the taxpayers.
So I think the Fed's recent balance sheet, weekly balance sheet, suggests that it is already earning profits. The amount of accumulated losses that it's showing is started to go down very slowly. And as interest rates go down, and they went down further yesterday with the FOMC's decision, the Fed's profits will pick up. So the Fed is already on a path to recoup the losses that it made and start putting money back to the Federal Reserve.
And a final point, my time is running out. So to the average person, if you're a small business or a family and you're hearing this debate about interest on these reserve balances, how does it impact them? Why is it a good thing that this law is in place? And are there concerns that you have?
So I think it's a good thing because it helps. This goes back to the first question, Senator Peters. It goes back to what it enables the Fed to do. It enables the Fed to protect economic stability and financial stability. And without that, the recession in 2008 would have been much worse. The recession after COVID hit and the disruption in financial markets, the financial markets weren't working. And when they're not working, you can't get credit to households and businesses, small businesses or large, households, et cetera. The Fed had to step in and buy those securities in order to restore functioning. IORB enabled it to do that, knowing that when it was time to fight inflation, they still had the tool to fight inflation. Without IORB, inflation might be higher, the economy might be weaker, the stagflation could be worse.
Thank you. Thank you, Mr. Chairman.
Senator Langford.
Thank you. Thanks for the conversation on this. This is important because we're dealing with the financial future of the country. Two big issues here. Congress has got to be able to work on getting our debt down. First, our deficit down, our debt down. All these things are patchwork with the Federal Reserve trying to be able to figure out how to be able to manage the economy with the amount of debt that we're currently carrying as a nation. Second thing on this, though, is this is an entirely new system that's out there. We're talking the last 15 years, the rules have changed and everything. The amount of quantitative easing, what's actually happening with the interest on reserve balances. This is an experiment. We really don't know where this goes 50 years from now, 35 years from now, and some of the acceleration. And so it's entirely reasonable for us to be able to have this dialogue, to be able to talk it through and to be able to deal with. Let me try to deal with a couple of things on this. One is the amount that's interest on reserve balances given to foreign banks. Obviously, that is in direct competition with our domestic banks, obviously, but it's also what would have been American tax dollars going back into the Treasury, actually going to a foreign bank to be able to stabilize their reserve balance as well. What effect does that have on our American economy for that much money? Does anyone know the amount of interest on reserve balances Federal Reserve has paid to foreign banks?
I think this was in the study that Dr. Paul released, and it is substantial.
Substantial.
And because the foreign banks do hold lots of deposits at the Federal Reserve. It serves a purpose for U.S. and foreign citizens. The foreign banks help to facilitate transactions between countries. They help U.S. exporters, for example.
But if we go back 15 years ago, it was bank to bank that were actually dealing with this rather than the Federal Reserve being able to hold it over.
Right.
And my bigger question on this is really what, if we were to, let's say, slowly taper this away. There's been some arguments to say 6 months is too fast. Dr. Paul is always in a hurry to solve every problem. So they've said, you know what, his bill is just too fast to be able to implement on this. We need more time than that. When I ask the question of banks and to say, how much time you need, it's always as much time as we can get. But then my second question to them is, what would you do instead? And every one of them I've talked to said the same thing. We would buy treasuries. I was like, why is that a bad thing for our economy, for banks to be able to buy into treasuries? We're selling treasuries already at record numbers out there. We need consistent buyers on this. Why is this a bad thing for us to switch from interest on reserve balances to actually banks actually buying treasuries?
It's not a bad thing. And if they want to buy treasuries, they can buy treasuries, and that's fine. And if I want to buy treasuries, I can buy treasuries, but I can't take the proceeds from my sale of treasuries and park them at the Fed and earn exactly what I was earning when I had the treasuries. That's why it's a windfall.
Right. Anyone else make a comment on that?
Well, you're talking about whether the Fed should be buying the treasuries or the banks.
The banks.
Right.
The banks.
So the same number of treasuries need to be sold to fund the deficit that you and Senator Johnson were talking about. So that, and the question is whether it's the Fed or the banks. And certainly, before 2008, the banks found ways of making these transactions. It was perhaps a bit more cumbersome than it is today with the interest on reserves. So yes, they'll find a way of doing the same things, but you will handicap the Federal Reserve. Remember, Congress actually authorized this in 2006. I testified in 2004 in favor of paying interest on reserves, so I'm a little consistent over time. And my point then was not paying interest on reserve balances was a tax on the banks. The banks naturally were trying to avoid the tax, as we all do. They avoided the tax by keeping deposits lower, by discouraging certain kinds of deposits where they have to hold reserves, and by passing on that cost to borrowers and lenders. So I think the Congress recognized the inefficiencies of not paying interest on reserves and authorized the Fed to do it with no expectation that a 2008 would come about.
Right. Yeah, the challenge is, just for basic safety and soundness of a bank, there is a good reason to be able to keep significant reserves in a bank. But to be able to say that just because we require you to be safe and sound, that's a tax on the bank, that's a part I guess I don't agree with. That's just
well, when we weren't paying in, so we said to the banks, you have to keep deposits at the Federal Reserve paying zero. You have to make an interest-free loan to the government. That's a tax.
Right. Well, Mr. Westbury, you're about to say something as well.
Yeah, okay. Yeah. From the beginning of the Fed all the way through 2008, we did not have banking problems because banks had too few reserves. That's not why we had banking problems. The great financial crisis did not come about because banks had too few reserves. That's not what was the problem. And so, and the second point I would make is that quantitative easing didn't save the economy either. We passed quantitative easing in September of 2008, and the market fell another 40% after that in the next 9 months. And it wasn't until March of 2009 that everything turned around. And the one thing that changed then was we altered this mark-to-market accounting rule. That was the real problem with the banking system. And what the Fed did is they took advantage of that crisis and grew their balance sheet massively. From $850 billion to today over almost $7 trillion. And then the second point I would make is, yes, the bank should own the Treasury bonds. Instead, what's happened is that the Fed buys them. And the Fed now, on the Fed's books, there are $800 billion of losses from the Treasury bonds it bought during 2008 and then again during COVID. And so what they really did is they took the risk out of the free market and put it on the Fed's balance sheet. And because the Fed doesn't care about losses, they don't mark them to market. They can print money to take care of the losses. And so what this has done is distorted the economy and allowed us to spend more as a nation than we would if we had to pay the real price of that borrowing.
Okay, thank you.
Senator Scott.
Chairman, thanks for doing this. Thanks for holding this hearing. I think Jay Powell's a disaster. If you just look while he's been, it started a little bit before him, but the balance sheet went from what you said, Mr. Westbury, $800 billion to now it got to $9 trillion. Yep. And it's around 7, and now he's starting to increase it again.
Yeah.
Yesterday they're going to announce it $40 billion more a month. Yeah. I mean, we don't have a financial crisis today. Mm-hmm. So I've been trying to get an independent inspector general because nobody will even investigate the fact that they've had insider trading issues, stuff like that there. So it makes no sense to me. So so let me, Mr. Westbury, let me ask you first question. What's the balance sheet and what's the liabilities? What's the spread right now?
At the Federal Reserve?
Right.
Well, the balance sheet is now 7.6 times larger than it was back in 2007, and it's $6.5 trillion. So we've gone from 850 billion to 6.5 trillion. The Federal Reserve owns the bonds on the other side, but they have an $800 billion loss on those
Mark
bonds.
to market, if you're a bank,
Yeah, they would be 850 billion in the hole.
right, and the capital account's only like $45 billion,
Right.
$43 billion at the Federal Reserve anyway.
A private entity, they've lost 40 times their capital. I have tried to get an answer to a question is how does the Fed keep the lights on? Because they have lost 850 billion on their portfolio and they're losing 180 billion dollars this year.
So before what Powell.
And how do they finance the CFPB, which they're financing out of their profits as well?
Right.
Yeah, so Powell's, and he's losing about $200 billion a year, right? Mm-hmm. Okay, so he's funding that by just issuing treasuries, right?
By issuing reserves, basically by
Yeah, issuing
just
treasuries.
writing the paycheck. And,
Yeah,
yeah.
so he just gets to keep losing.
The Fed is not a profit-making institution. You, the Senate.
Wait, was before Powell.
But
It sent money every year, right? It sent money every year to the Treasury.
The Congress has given the Fed certain responsibilities for stabilizing the economy and stabilizing prices and protecting the financial market. These purchases and those losses were incurred in the process of meeting the goals that you, the Senate and the House, set for the Federal Reserve. You did not set a goal of profit
Yeah.
for the
I
Federal
think
Reserve.
that's legitimate, but they've failed in doing that. I mean, as Mr. Westbury said, they bought these treasuries to try to control all the interest rate through the, not just short term, but 10-year and 20 and 30-year, okay, and it caused a misallocation of capital. I mean, a complete misallocation of capital is what he's done, and no accountability. So here's what I don't get. So why do they have reserves in the first place? Let's go through that. They have reserves because in a normal business, you have to have reserves.
Right.
So I've owned manufacturing companies, okay? If I went to the bank and said, I want you to lend me 100% of the money, they would laugh at me.
Mm-hmm.
They didn't, then the bank said, okay, we'll lend you money, but we're not going to pay you to hold the reserves you have to hold, right? Isn't that the same thing? How's it any different? I mean, I never get this. Why we're paying them to hold what a normal business has to hold.
Right.
And they're leveraged to the hilt.
And for decades, banks held about 10% reserves.
Right.
And now by doing quantitative easing, we bump that up to over 30%, and then we pay them to hold that.
So they use our guarantee to get deposits.
Mm-hmm.
They use the federal government's guarantee to get deposits, and then we pay them to get the reserves that justify us giving them a federal guarantee. But I used to borrow money from banks. They didn't say, oh, you got to hold capital, 20, 30, or 40% capital, and I'm going to pay you for that. That's what is crazy about this. And then the fact that they keep losing this money and they act like it's going to change. I mean, why? I don't get how they keep saying, oh, it's going to get better. How?
As interest rates come down, the amount of money they're paying the banks will come down, and the money they're earning on their portfolio comes down much more slowly because it's a longer-term portfolio. So they're already making money. Senator.
If that's true, then why did they have to yesterday announce they're going to start buying another $40 billion of treasuries?
Because the funding markets were being disrupted because reserves had dropped low enough that the banks weren't arbitraging back and forth in these funding markets. So they're increasing those reserves.
No, it's because they couldn't get the banks weren't happy with the interest rate they were getting. So now they have to buy up the treasuries to deal with that. I mean,
We have to remember that the Federal Reserve is the one who creates the reserves. The banking system doesn't control the amount of deposits at the Fed. The Fed controls the amount of deposits at the Fed. So the banking system can pass those deposits around, but it can't.
Let's make it real simple, okay? So we're paying banks to hold treasuries, or we're paying them interest, one or the other, right?
Right.
Right? But why would we pay, I just don't get why we're paying on capital and how that helps. Like in my state, okay, if you go around my state, the rich are doing fine. Right? I live in Naples, Florida, they're doing fine. I talk to them, they're doing great. You know who's getting creamed because of the Federal Reserve? The poor. Mortgage rates are up. As they keep playing with short-term interest rates, what's happened to the 10-year and 30-year? It's gone up. Right?
Yeah.
And so now they're going to try to play that by buying that's been building the balance sheet again. This makes no sense. I mean, if you look at since Powell's down there, I mean, he said inflation was transitory. It wasn't. I mean, what they've done is caused massive inflation in this country. Right. Stop doing it. I mean, I don't get this stuff. Why we just allow them pay interest to banks, keep buying more treasuries. It just doesn't make sense. They're out of control. I mean, do you guys disagree? I mean, am I looking at it differently than you look at a normal business?
Yes, it's not a normal business. It's part of the government, which is why Senator Johnson is right. You should look at it on a unified basis. The issue here is that we should take away the market distorting piece of this and let it be priced in accurately.
Let the market work.
Yes.
Yeah. I didn't get it when I wanted to borrow money at zero. When I was in business, I got stuck with the darn banks, what they wanted to charge. Why don't we let the Federal Reserve do that? Let the market work. So, I'm sorry.
No, that's good. And we're going to continue for a little while because I like the discussion. Dr. Cohn, you said that really one of the primary goals of the Federal Reserve is not to make money. That's correct. You know, have inflation and employment, but there probably are other ways there are infinite amount of ways they could address those goals. You might also argue that a central bank that loses money might not be a cause for bragging about, or that it might not be part of your goals to have a central bank that loses money, that it might not be comforting or accentuate or help with the idea of stability within the economy. I'm going to throw out a question that I think I just want to hear the response, and it may be a little bit off the wall. What if we had a banking system that was just based on fraud and lack of fraud? So if I give you money and you decide to loan it, you have to pay me interest, and we have a contract. I'm not going to come get my money for 5 years and you're going to loan it, and that's all you would loan, and we didn't have any other rules. And the interesting thing is this, about 25% of money that's loaned out is checking account money, but you don't have a contract with me. And the reason why the whole system is always a house of cards and could go under is if everybody wants to get their checking account money, it's not enough money. So basically, we have a fraudulent system. Fractional reserve is a fraudulent system. But what if you did nothing else? And I'm not asking you to advocate for the policy. I just want to know, about 25% of the deposits are checking. You could still loan some of it out if you tell me I can't. I can only remove 90% of my checking, that you'll pay me a little bit of interest. But right now, you take my checking account money and basically don't pay me anything, and you get, the banks get to make money on it. What if we just had a system of banking based on fraud? We'll start with Dr. Michel.
If I understand where you're going.
You can only loan out money that you have
Yeah.
permission to loan out, and you got to make an agreement with me. If you're going to loan my money out and give it to somebody else, I'm going to forgo it. You got to pay me some money, and you're going to take a portion of it. But I didn't make that. When I put my money in my checking account, I want it all there, but it's not all there because you're loaning it out. So that is a fraud. The banks are committing a fraud every day by loaning out my checking account money.
Well, I mean, that is disclosed. I wouldn't call that fraud, but if.
But what if you weren't allowed to loan out stuff you didn't have permission to, and let's just
That would be
say
good. If you
consider-
weren't allowed to loan out stuff that you didn't have permission to loan out, I'd be okay with that.
I guess it's too far outside the box. Mr. Westbury.
Well, actually, I'm going to take this in a little different way. We have FDIC insurance right now, so everybody's covered to $250,000. And I've always argued that we should get rid of that. like that encourages banks to not, actually Silicon Valley Bank went under, we covered every penny of all their deposits. And what we should have is a system of gradation. You give me, I'm a bank, you give me your money, you want no risk. I take it and I buy treasury bills. And then you only then earn 2%. You'll take some risk. So I buy half treasury bills and I make some loans with the others, and now you earn 3%. Or you want all risk and I make all loans and you make 4%, and you get to choose. And then on the way out the door, you could buy insurance from Goldman Sachs. They have a desk at the door. You just bought that, you just deposited your money. You can get private insurance. And so what you're really getting to is where the depositor has control over how the money is used. And that's a system that's a free market system of dealing with insurance. Right now, we have government insurance on banking deposits, and that can lead to really risky bank behavior.
So I think that's called mutual funds, isn't it?
Well, it is, yeah.
So those things are available. So I wouldn't say it's based on fraud, Dr. Paul. I would say there is liquidity transformation in the system, and there always has been, in which the banks lend out at a longer term than they get their funds in demand deposits or savings deposits or short-term deposits. And that creates risk. And our country was subject before 1913, before the Fed was founded, to periodic recessions, very severe recessions when there were runs on the banks. The Fed was created to have a lending facility so the banks could meet those runs and wouldn't tighten the credit system and create very severe recessions. So there's risk in the system, and we need to make sure the banks are resilient and can take the risk and understand the risk, and the deposits at the Fed are one source of liquidity.
The reason there is a fraud that exists is that if 100% of people want their checking account money in every bank in America tomorrow, it's not there, right? So we still are liable for bank runs. The government just pays for it through the FDIC. And we still do have bank runs on occasion. You know, we have had some of these crises. Going back to the issue of the money supply tripling, and it's always fascinated me. I know it's not arithmetic. It isn't exactly. You don't triple it and have a third. You know, prices go up as triple. But and some of that, you could argue that the IORB is, if you're going to have massive inflation, is a useful tool. But the opposite argument of that is, if you have this useful tool, you're going to have a lot of inflation. It's a way to make inflation not so bad when you're going to pump tons of money into the system. But the counter argument would be, maybe you shouldn't be pumping tons of money into the system. It's the same way with the Federal Reserve. You know, we have many people out there, you may not know them, but think we shouldn't have a Federal Reserve. But I always tell them, yeah, if we had a balanced budget every year, we probably could. You could have AI could run the system, have 1 or 2% inflation a year, and you know, tell everybody what's going to be. It'd be very predictable, and we wouldn't have any ups and downs, swings of this. It just is what it is. You'd have great predictability, but you would have to balance your budget each year, so you didn't have to have these wild swings. And that was the whole thing of the pandemic, was this massive amount of borrowing and then all the flooding of money in there. And everybody got free checks. It was a terrible thing we did, and none of it was necessary, including the whole science behind making everybody crazy over COVID. Sure, it was bad, but it wasn't anything like the response to it. The response was insane. But going back to the inflation issue, I have just one other question, just sort of for the panel, is I've always wondered whether some of the reason we don't have as much inflation as the money supply created, or at least some of this, is that we export inflation, in the sense that we import more than we export. So we're always sending dollars overseas over goods, and it's an enormous amount of money. And I know it equilibrates within the system, but we have entire countries that are on the dollar standard now. So as we inflate, I mean, there are whole countries in Africa where the only thing you see changing hands is dollars. South America, the same way. So is there, is some facet of the lessening of inflation that all those dollars aren't chasing American goods? We export them and they're chasing worldwide goods, so we don't have quite the impact of inflation that we would have with the tripling of the money supply. Why don't we just go down, start with Dr. Michel?
From the studies that I'm familiar with, I would say no, that's not the primary reason.
Ryan?
I'd say dollars come back to the U.S. that come abroad generally in the form of foreign investment. If other countries choose to dollarize their economies, whether it's by importing dollars from here.
But I guess the question could be some of that investment goes into the stock market. So the stock market may have inflation, but the consumer price index isn't. So, I mean, you could be, that's what I'm asking. Could you be shifting some of it away from consumer price index and you see inflation in the stock market? But Mr. Westbury?
Yeah, there's a number of ways that the amount of money doesn't always equal the amount of inflation. And it's productivity. We never know where the money can go into. There are countries that are dollarized. They completely use dollars, and so that money is out of the system, and that means money growth doesn't matter as much. But a question or a point you just made before, I want to highlight something. Between 2020 and 2022, COVID, the federal government issued $7 trillion worth of debt. The Federal Reserve bought 45% of that debt. This is monetizing the debt. And the Fed always says they don't coordinate with the Treasury. And I would argue there's probably not a phone call that says, we're going to issue this, you're going to buy that. But isn't it interesting that quantitative easing happens at the same time we pass these huge spending bills? And then the Fed ends up buying over half of that debt. And the Fed does not have the same risk. They have a different risk tolerance than the banking system would. And so they will pay or accept a lower interest rate than the market would have in order to do this. So not only did we do crazy things during COVID that we overreacted, but we overspent, and then the Fed financed it. And that's one of the huge problems of this abundant reserve policy, is that the Fed is monetizing our debt. And that's
I think
inflationary.
It's sort of a corollary of what Friedman would say about spending, that nobody spends somebody else's money as wisely. It's the same with borrowing. Individual bankers and people who will lose their livelihood are going to be wiser, not because they're smarter people than at the Fed, but because they stand to lose more. They have a personal responsibility to it. Senator Johnson.
So I think the fact that the federal spending and the money supply and the QE were correlated were a separate response of the Congress and the Federal Reserve to what they perceived to be a very serious problem caused by COVID. There wasn't a cause and effect. I don't think the Trump-Biden deficits of 2020, 2021 would have been affected if interest rates had been a few basis points higher. The Congress wouldn't have passed those bills. I don't think that's, so they're both responding to the same thing. I think when you talked, Senator Dr. Paul, about sort of the money supply allowing inflation, there's some truth there, because rather than the money supply causing inflation, the Fed supplies the amount of money people demand. You set an interest rate and you supply the money people demand at that interest rate. That's the way monetary policy has worked. And they demand more in inflation. If you want to stop the inflation, set the interest rate higher. They'll spend less, they'll demand more money, less money in those circumstances. And I do think the stability of our financial markets is really important for the inward investment, to see the dollar as the reserve currency, to see U.S. securities markets as the safest, most liquid markets in the world, is a very important piece of keeping the.
I think what causes inflation is an important question. So, Mr. Westbury?
Yeah, okay. The way you described monetary policy, that the Fed supplies the money that people demand, I would argue that is absolutely true prior to 2008. Because what abundant reserve policy does is it separates the money supply and interest rates. For example, yesterday we saw it. That we're going to change, we're going to buy $40 billion worth of bonds, but we're going to lower the interest rate at the same time. You didn't have to do both, the Fed. You're not the Fed anymore, but you represent the Fed. But what we did is we completely separated. And when we changed from a scarce reserve system to an abundant reserve system, we took supply and demand out of interest rate markets. The Fed or banks used to trade federal funds every single day. Banks had a federal funds trading desk. The minute we started abundant reserves, all those desks are gone. There's no more jobs as federal funds traders because banks are overwhelmed with federal funds. They don't borrow them anymore. So you really don't have any way of knowing what the demand for money is anymore. It's not related to interest rates at all.
So I would say yes, IORB and ample reserves, abundant reserves, separated reserves and interest rates. Absolutely. The Fed's balance sheet and interest rates are now different, operate on different things. That's a feature, not a bug, in my view. A bug in your view, I get that. But I think the amount of money that people outside the Federal Reserve, not talking about banks, but people, you and me, Senator Johnson, Dr. Paul, demand in our bank accounts, that is not, it's not really affected by IORB. It's affected by the level of interest rates, right? So I think it's still M2, which is the stuff that people hold, is still demand determined based on the interest rate. The reserves part is not totally.
So let me try and clarify this by doing what I do in problem solving. Let's define the problem we're talking about here. I mean, you go back millennia. I mean, the Federal Reserve is really the culmination of millennia of people trading. You know, you used to do it with barter. That wasn't very efficient. So you started creating money. All kinds of different things were used, you know, trinkets and pebbles and, you know, all of a sudden precious metals, coins, that type of thing. In order to grow an economy, you need to expand the money supply. Mm-hmm. If you want to kill your economy, decrease the supply of money, but it's how you manage it. And so even though I agree with Gibbons, the author of The Creature from Jekyll Island, that the Federal Reserve is literally a cartel of these banks, and we have these central banks, the main task from my standpoint that I believe is they're trying to manage that money supply. Try and grow it to accommodate a growing economy so we have prosperity. The problem is, do we do it smartly? I want to quick go to mark-to-market. Mm-hmm. You know, I'm back there in Oshkosh, Wisconsin going, my factory's humming along. Why do we have this great recession? What caused this? It was stupid regulation. It was, okay, you could say these mortgage-backed securities was a stupid financing tool, but they weren't worth zero.
Right.
But our stupid regulation forced banks to write that down to zero, and we bankrupted banks. But I think in the end, those mortgage-backed securities were probably worth 80 cents on the dollar. Is that about right?
Absolutely.
I mean, how stupid. That's a self-inflicted wound. What I'm hearing out of this hearing, and I told you as I walked by, I said, this confuses me. Again, this is complex, but I don't think it is. And I love Senator Scott. I think he's just off base when he's getting all concerned about us paying interest to foreign banks. I mean, foreign banks would buy our treasuries. And the loss would just show up on the federal government's balance sheet versus the Federal Reserve, and I don't think the Federal Reserve is all that particularly independent. Okay, it's been given a task to try and manage our money supply. I think the main issue here is the moral hazard that you're talking about, Mr. Okay, by separating supply and demand, you know, by not having those daily markets. Again, the beauty of a free market competitive system are literally billions of transactions, billions of consumers doing all this stuff, and just magically works out the pricing. The minute you have government starting to do this, you just screw things up. And so I think that's the. If Senator Paul were to, again, I'd really have to try and understand, and nobody does. Nobody understands how the Federal Reserve uses this, you know, buying and selling, you know, to. You just don't, you know, I just don't get it. But I do get the moral hazard of doing this. I have no problem. The banks are going to park their money somewhere. They're going to get an interest rate either. They're going to buy the treasuries directly. Foreign banks, same way. Again, the problem is our massive deficit spending that has to be financed somehow. And we've given the Federal Reserve the ability to do that. And again, I think it probably on the margins, because we keep interest rates artificially low. You know, we feel a little bit less constrained. I mean, if we were paying $2 trillion in interest expense, it might. I'm saying it might cause us to spend less money. I'm not necessarily sure. I've been trying to get my colleagues to spend less money. We all have. I mean, here are three fiscal hawks. It's an impossible task. But in my base, it's really the moral hazard of this. And I get, Mr. Coney, you're obviously on a different side of these. I mean, do you acknowledge? I mean, that is a problem. With the Federal Reserve doing all this, we don't have all that market. We have that disconnect. We're making it easier for Congress to spend money, and that's a moral hazard.
Oh, I think it's minor, very small. That is, the amount of securities that the Fed holds, first of all, has gone down by, what, about $1 trillion, Brian? The reserves were over 4 at one point, and now they're around 3. So that's gone down over the last year. I haven't seen any move towards fiscal responsibility.
Senator Scott's always talking about the size of the balance sheet. I mean, we're $38 trillion in debt. I mean, so if the Federal Reserve, would we just have a bigger balance sheet on this side? Again, I just think it's a shell game. I just think it's a accounting convention in terms of how we're doing this. And the main problem is, again, what the federal government spends and what we don't take in, and the difference between that. I just think that is the problem that we're simply not grappling with.
I think it's a huge problem. The trajectory of the federal debt relative to GDP is a big problem, and a kind of a time bomb waiting to go off, but I don't think the Fed has caused it.
Well, let me end on this. The only thing that keeps all this thing going is confidence, right? I mean, you go back to It's a Wonderful Life, and it's just, back then where you didn't have reserves, all of a sudden, I can't get my money, and you get to run the bank, and nobody had confidence in the system. Yep. Confidence is absolutely critical. That's what happened in 2008. We broke the bank, that money market fund, and confidence just evaporated. I'd say the one tool that the Federal Reserve provides is just that backstop confidence. It's like, we'll print the frickin' money to make sure the financial system doesn't collapse.
Right.
And to have one central bank do that, I think that does provide confidence. That's what FDIC insurance is for. And again, with the savings and loan crisis, they increase that too much, create a moral hazard, but there's got to be a sweet spot there. We should have some deposit insurance to provide that confidence, but not $1 more, or else we create that moral hazard. I mean, am I kind of getting it's confidence versus moral hazard?
I think that's why the Fed was created in 1913, because there were these periodic losses of confidence. And the thought was, if you have a discount window, a lending facility, and banks can come and take their loans and borrow against them and pay out the deposits.
So you've got to read Creature from Jekyll Island, then we have to have a conversation. I'm not kidding. You ought to read that. It's a fascinating book. Okay, then, Mr. Westbury, you had a comment on that?
Oh, I just wanted to say that in 2008, we had a problem, subprime loans. It was a $500 billion problem. It was not enough. Even Chairman Greenspan has said, or Chairman Bernanke said this. It wasn't enough alone to take down the U.S. economy. Today, with this new system, this experimental system, as Senator Langford said, the banks plus the Fed have over $1.5 trillion of losses on their books. And it's because all these bonds were sold during COVID, during 2008, at extremely low interest rates. Now interest rates are higher.
But again, we have $38 trillion of losses on our books. So you add another $1.5 trillion, so we're $39.5 trillion. And by the way, on a path of about $62 trillion in 10 years.
And what I would argue is we have a bigger financial problem today than we did back in 2008, and it's with all of this supposed monetary policy that's made us safer. So I would argue that we're less safe today as a financial system than we were when we started this back in 2008.
Thank you. Again, I want to thank the chairman for having this hearing. I want to thank all of you guys. I mean, really, this has been a good discussion. This is absolutely within this committee's jurisdiction. I mean, so I really appreciate this.
Senator Scott.
So let's go to what Senator Johnson said, paying money to foreign banks. Let's say we stopped doing it. What would happen? Let's say we said we're only going to do it to U.S. banks, and banks domiciled in the United States, headquarters in the United States. What would happen?
Stop paying interest to the foreign banks, is that what you said?
Stop paying any interest.
Well, they would get rid of the reserves, right? They would sell off the reserves. That would put downward pressure on interest rates. The Fed would have to absorb that in order to keep interest rates from rising, or the U.S. banks would have to end up with that, and they'd have to be induced to take those reserves. So it would end up, it would
Why wouldn't they?
tend to pressure interest rates lower at a time when inflation is already at 3%. I think that would be a problem.
Why wouldn't if the U.S. banks are going to get paid interest on it, why wouldn't they just pick up the slack?
Well, they already have the reserves they want to hold. I mean, the Fed could make them, they could have to pick up the slack. That is, the Fed determines it. They could pick up the slack, and then they would have the reserves. But I'm not sure what you'd accomplish that way.
Well, what it accomplishes the fact that I think the Chinese government wants to destroy my way of life and my family's way of life, and I don't want to give them a dime. So I don't want Chinese banks to have a dime, because I think they're going to take. If Chinese government is despicable, they're going to take everything they get. They're going to use it to build a military to destroy my way of life and my kids' way of life. So,
I think that's a potential argument. You don't want Chinese banks operating in the United States.
That would be fine with me.
Then somebody, not the Federal Reserve, but somebody needs to pull that plug.
So if the IORB was eliminated, would the banks also lend more money to small businesses? Because right now, I mean, my first business was a donut shop. I went to the bank. They lent me $7,500. You can't get a loan like that from a bank today. I don't know any bank that's going to make a loan like that today. So if we stop paying interest on reserves, would they maybe start helping small businesses, which they don't do anymore? Any of you?
Well, what they would have to do is take whatever assets, they have the reserves, they'd have to trade them for some other asset. So they could buy treasury bonds with those reserves, they could make loans with those reserves. Right now, they're constrained by rules. One of the interesting things, this is going to change the corner, but I'll come right back, is that Chairman Powell yesterday said, we're going to start buying $40 billion more of Treasury bills every month. And the reason is because there are now pressures in the repo market. We can see interest rates starting to act funky and volatile.
They lost control of interest rates.
Right. But
when it acts funky, that means they don't get to dictate exactly the price.
That's exactly right.
They should be honest. They want to control everything.
Yep, that's exactly right. So, what's interesting is the reason we are at that point is because they have set regulations so tough on these banks that they're forcing them to hold this amount of reserves. And then they brought the reserves down right to that level, and they go, oh no, now we have to increase them. They could easily reduce the liquidity rules. And if they did that, more loans would go to small businesses.
Because you can make a profit off it.
Yes, exactly.
So now what they're doing is impacting small business ability to get a loan.
Absolutely. They're forcing banks to hold reserves instead of make loans or buy treasury bonds.
My state, who's getting hurt are the poorest families that don't have the relationships to go get a loan. Like I had no relationships to go get the $7,500 when I got out of the Navy to buy a donut shop. If the bank hadn't lent me money, I don't know how it would have gotten started. I had no relative I knew that had $1,000.
Yep.
So what they're doing is they're making it harder for small businesses to get started, and it hurts the poorest families in this country.
Exactly. The banks are flush.
That's a product of the regulation, not of the interest
By the
on
Federal
reserve.
Reserve.
And all the other regulators trying to keep these banks safe. Now, you could argue that they went too far after 2008. That's what the administration is arguing, and they're pulling the regulations back. We'll see whether that happens. But it's not the reserve balances. What would happen when the Fed sold the securities that created the reserve balances, and your world in which the balances went down? They'd extinguish deposits. They sell me a security, they get my check, they clear it against my bank, right? So the bank doesn't have, just because the reserves go down doesn't mean it has more money to make loans
But they
because it
might have
has fewer
incentive.
deposits. The reserves and the deposits will go down
But they have an
together.
incentive to make a loan because there'd be more money.
But they also have more trouble managing their liquidity. And this is a problem for smaller banks which
Why
don't
do we
have the,
banks? I mean, the way I look at it is what we've done is we create all these rules and regulations so the banks can't even do what they're expected to do. Lend me money so I can start my little business. They're not doing that today. You can't go. I mean, you have to go get. Your consumer credit is interest rate of 20% plus from the credit cards. That's the only place you can get it. So you said, I think Dr. Coney said that they didn't have an impact on interest rates. So if the Federal Reserve had not been buying 40+% of the treasuries during the Biden term, all right, then you think interest rates would have stayed the same?
no, I think the Treasury rates would have been a bit higher, and mortgage rates would have been a bit higher, and rates on auto loans would have been a bit higher, and there'd be less spending on houses, autos, and the recession would have been deeper.
Okay, and so all we did is we decided when we do that. So now what's happening, like in my state, as the interest rates are not coming down, long-term rates are not coming down, then the value of homes are coming down. So what they did is they caused a significant asset bubble.
But that's not under the control. You said the Fed wants to control everything. What they want to control are the rates at the very short end of the market, the repo rates.
That's not what they bought. That's not what they bought. They bought long-term.
But now they're getting rid of them,
Yeah,
right?
but no.
And they're not. And the new QE is bills.
They bought long-term because they wanted to control.
In order to keep those rates down, they stopped doing it, and they're reducing. They were until December 1st, reducing the amount of securities.
So they caused this ridiculous bubble. And now what's happening in my state, people are getting their butts kicked. They bought a house, right? They bought a house, and now the prices of the house is coming down because interest rates are not coming down. I mean, it hurts the poor. And again, it's always the poorest families that get hurt. The rich have plenty of cash; they can't do it. The people who are leveraged to the hilt, they are getting their butts kicked. So I get so frustrated. They cause these bubbles, and then the poorest people are the one that get hurt. So.
Thank you. One of the points that Dr. Coney made is that the Fed tries to accommodate the public's demand for money.
Right.
And I guess I would argue that particularly in the subprime loan crisis, that it was made worse by the Fed creating interest rates below the market rate. So in a real economy where the interest rates, because they're set by a vote, I mean, we don't set the price of bread by a vote. This isn't a real market pricing system. A bunch of old guys at the Fed vote on what the price of money should be. But in a real economy that has freely floating interest rates, if you have a housing boom and everybody wants to borrow money, you have increased demand for the money. The response would be the interest rates would rise. But you had a period of time from like 2000 to 2007 where you got interest rates at like 2, which is essentially 0. If you got inflation of 2 or 3 and you got interest rates of 2, your real interest rate's like 0. That's not a real interest rate. And I don't think the market would do that. As you have this housing boom, interest rates would have risen. And so the cycle of the economy is incredibly dependent on interest rates to tamponade the effect of the boom. So as you get a boom, as interest rates go up, only the better projects, the ones more likely to succeed, will happen. And if I'm borrowing something with no capital, it's less likely that I'm falling away as interest rates go up. But if you don't allow that, you're part of what creates the boom. The Federal Reserve was responsible in some way for the boom by keeping interest rates below the market rate. I'm not going to start with you, but I'll come back to you. Let's start with Dr. Michelle. What do you think of what I've said?
Well, it definitely has an effect on rates. It's probably not positive in the sense that it's not a good outcome. But I also think it's very important that we don't divorce what the Fed's doing in that regard from what the rest of the federal government is doing. The Fed didn't decide to create TARP. So there's a lot of money floating around, and any of the money that they did provide for liquidity could have been provided through Congress, and a lot of it was done in both places. So I think it's hard to separate out.
The low interest rates leading up to it also have a reason. I think they may say they want to help the economy, but they're really trying to keep the financing of a $38 trillion debt manageable. So that's a big reason for why we'll get.
Also combined, yes.
Yeah.
Yes.
Ryan.
Yeah, it's a question of trade-offs. If you lower interest rates, yes, you lower the price of government debt, and that can be very important for the federal government's fiscal health. But the trade-off of that is higher inflation for the rest of us. So you can choose one policy or the other, but you can't choose both because there will always be a trade-off.
Mr. Westbury.
Yeah, and bubbles as well. I mean, Brian, you're absolutely right. The interesting thing today is pre-2008, we had a scarce reserve system, and banks traded reserves every single day. There was a marketplace. Once we have made abundant reserves, nobody trades federal funds. There is no market rate anymore. And that rate now is, Dr. Paul, you're absolutely right. It's set. They sit around a table and they go, what do you think? 3 1/4, 3 1/2, 3?
But I guess my response to that is between 2000 and 2007, we were still doing, as you say, having this daily marketplace. Right. I would still argue that from 2000 to 2007, that the interest rates were at the direction of the Fed below the market.
Well, I agree, because they were adding reserves that they shouldn't have added. And so it can happen under either system. Right. It can totally happen. But today, there is no market input at all. That's what I would argue, that the Fed cannot see the demand for money. They used, when the rate would want to go up under the old system, that was a demand for money. Today, there is no sign of demand for money like that.
I think we've got a pretty good focusing of this debate. Is this debate going on outside this room? I mean, to a large extent?
I wish it was going on more. One of the things I will say is that you and your staff study, which is fantastic, for the first time that I know of, forced Chairman Powell to address the ample, abundant reserve issues in a speech, because the Federal Reserve has kind of ignored it, acted as if it doesn't really exist, and the press doesn't ask questions. So thank you for pushing this.
And I think the point that we've gotten to is a better and more important point about whether the Treasury loses money, the profit loss of the Fed. We're talking about whether or not the interest rates are being set by a daily marketplace versus a long-term thing, which seems to be more of a decision by fiat, a decision by a bunch of, let's just call them grumpy old men around a table.
I call it price fixing.
I don't think there's any difference between the way rates basically were set before 2008, and I was part of this back into the 1970s when I joined the Federal Reserve. Every day we had a call with the Federal Reserve Bank in New York, and we decided, the Federal Reserve Bank in New York and the board staff decided how much money they needed to put in or take out in order to fix the interest rate, right? So the mechanism was a little different under scarce reserves, but the control of the federal funds rate, of the short-term interest rates, the repo rates, were just as strict before 2008 as after 2008.
And I would argue that one of the things that brought down the Soviet Union is that nobody knew the correct price of bread, because the marketplace doesn't work because nobody does. I said it here, and then I got bread rotting on the shelves. I said it too low. All the bread's gone. The only thing that can figure out, and this is the miracle of capitalism, is that supply and demand, and as Senator Johnson said, millions and billions of people trading instantaneously leads to just this incredible knowledge that no one possesses. Right. It was this whole idea that Hayek talked about, the conceit, the conceit of a bunch of 10 really smart men. And I'm not begrudging the people at Fed not being smart. They probably are very smart, but they're not as smart as a million people in the marketplace. So what we should try to do is have as little impact from the Fed on what interest rates are, and figure out a way, if there is a transition to a more market-oriented, where most of the interest rate is determined by the market. Because I think between 2000 and 2007, under the old system, they were manipulating. I think it caused the subprime crisis. I agree, mark-to-market probably exponentially made the subprime crisis work. But it got started with the subprime crisis, which I think was directly related to interest rates being, lower than what the market would have dictate.
So, I mean, the market controls every interest rate beyond the overnight interest rate. So if the market thought what the Fed was doing was, right now, lowering rates was inflationary, you would see it in the bond market, and you don't see it.
But then they also control the money supply. So don't you think the money supply has something to do with interest rates also?
I think it's the amount of money, the M2 money supply is the amount of money people want to hold at the current interest rate.
And I would argue the Fed influences interest rates out the yield curve too, and that's what the whole idea of forward guidance is. And this is, don't mean to take us off this path, but they've tried to influence long-term rates with forward guidance and by buying different parts of the yield curve.
In these zero interest rate situations.
But you are absolutely, under the old system, they certainly could hold interest rates lower than they should, and they did. In fact, they helped cause the housing bubble. The interesting thing is, in that system, at least there was some market input. Federal funds trading desk is giving a signal. Under this current system, there is no market input. Right. And as a result, I think it's even moving back a step to that scarce reserve system would be a step forward, and then we can talk about moving
Dr.
forward.
Cohn, are you familiar with the Austrian understanding of the business cycle and explanation of the business cycle, and do you accept the idea?
A little bit, I'm not.
The ideas were basically that inflation and the effects of expanding credit hit different segments of the economy at different times. They lead to misinformation. They lead to a theory that you believe you're better off than you actually are. And so capital goods makes a decision, consumers make a decision. There's a time lag between these two, and by the time it catches up and the consumers say, oh gosh, we have 3 times as much money, it's worth a third less, the capital goods people are still making stuff, and then that differential and that separation is what causes it. It isn't like on TV it's presented as, well, gosh darn it, we just don't know what causes inflation. And we don't know what causes it. It's just a mystery what causes the business cycle. Yeah. And I think it was actually explained pretty well by the Austrians.
Yeah, so I think I agree that expectations are very important for how people spend, and they form their expectations by looking around them. I also agree that people tend to get very optimistic in the up parts of the cycle and very pessimistic in the down parts, and that's consistent with the story you're telling.
The key factor that counteracts either irrational exuberance or any of that is the interest rate. So if the interest rate doesn't rise, it's the one price that is universally throughout the economy. It's the one thing that will slow an economy down that is going too rapid. And by too rapid, I don't know that. It just... There is a point at which the economy is growing so rapidly that you feel that you're in a bubble. It's not my job to figure that out or to tell the economy to stop. But as interest rates rise, less things will be financed. There will be less loans.
There was very little inflation in 2006 and 2007. So I was I was voting on interest rates in 2006 and 2007. And we did raise rates for a while, up to around 5%, I think. So not 2%, but more like 5%. So their real rates were positive. There is an argument, and I've had this discussion with John Taylor, for example, that the Fed should have raised rates a little more because the inflation threat was higher. I think the problem was regulation. There was too much deregulation. There was too much reliance on the private sector to make decisions, and without constraint and without recognizing the knock-on effects, the externalities, economists call them, of the decisions they were making. And risk built up in this euphoria, to your point about cycles. And then when it collapsed, it really collapsed. And you're right, it was a loss of confidence that really caused the financial crisis in 2008. The losses were there.
I just have one question. It does relate with markets setting interest rates. But there's if I stand through it, there's 2 problems. I just want to ask whether they ever consider the other problem. So obviously, interest rates too high, it constricts economic growth. Too low could maybe lead to exuberance. Is there ever a consideration of the misallocation of capital within that? I mean, in terms of where capital actually flows. First of all, just in terms of far riskier assets, which can misallocate capital. I mean, is that ever part of the equation, or is it simply just, is the economy going to heat up, it's going to slow down?
So that's part of the discussion, but the Fed really has one instrument. Let's forget the QE period. Under 95% of the time, the Fed is trying to balance the economy using the short-term interest rate. and they can't, giving them another target, telling them that was maybe a problem. So
Yeah, I'm not asking them to manage. I'm just asking, I mean, is that a consideration? Just, I mean, have anybody look back for the last 25 years and go, man, we really misallocated capital. We had too many things flow into this area, sector of our economy, because we kept interest rates artificially low. It was just free money. Or am I just off base here?
It happens. It happened in the housing bubble in 05, 06, 07. And I would argue we've misallocated capital toward government with these 0% interest rates in 9 out of the last 15 years. When you have 0% interest rates, it's pretty easy to finance government and make it seem
It's
cheap.
been more than 9 out of the last 15 years.
Yeah, but I mean, zero. They had zero.
Right,
By the
right.
way, this is
But
one
I'm
of
saying
the,
misallocation to government.
by the way, it's one of the arguments that I would use about getting rid of interest on reserve balances. The Fed did hold interest rates basically at zero for 9 years. And that was okay by them. And now when we want to get rid of interest on reserve balances, they go, well, you can't force us to hold them at zero. We can only hold them at zero when we want to. And so I would argue that's not a really good argument to make, that you
And
can't.
by the way, you're right. The misallocation, the primary misallocation was to government.
Yeah. Yeah,
thanks,
and it was
Mr.
also
Chairman.
to houses and other things. But the Austrian business cycle is a fabulous thing, and that's misallocation of resources happens when you hold interest rates too low.
So I think this has been my favorite hearing of the whole year. And even though the minority says it wasn't under our jurisdiction, the one prerogative of the chairman is I get to decide what is under my jurisdiction. And we weren't creating law today, but I think we had a very helpful discussion. We had viewpoints, I think, across the spectrum. And I think it was, very good. And I hope we'll pursue this. And to each of the participants, Republican and Democrat, I'm happy to hear from you anytime. If you have advice, something you've written, and you want to send it to us, it is. I don't claim to know everything about it. I know this much and like the subject and want to know more. And but I would claim a lot of other people are in the same boat, not necessarily that there is some committee that knows more than the rest of us. But thank you all for coming. The record for this hearing will remain open until 5 p.m. on Friday, December 12th, 2025, for the submission of statements and questions for the record. The hearing is now adjourned. Thank you.